Beijing cracks down on industrial overcapacity. Steel, coal, and solar industries surge. The recent surge in commodity prices, particularly in steel and polysilicon, signals a pivotal moment for China's economy, as investors are increasingly convinced that the government is taking serious steps to tackle the issue of overcapacity. This month alone, prices for a range of industrial commodities, including coal, steel, polysilicon, a key material for solar panels, alumina, and lithium carbonate, have seen remarkable increases, ranging from 10% to an astonishing 68%. Additionally, shares of companies involved in steel production, solar panel manufacturing, and clean energy have outperformed the benchmark CSI 300 index, indicating a growing confidence in these sectors. This price movement aligns with a significant announcement from Beijing on July 1st, where officials expressed their intent to address disorderly price competition, a term that refers to the rampant overcapacity that has been a persistent issue, contributing to domestic deflation and creating trade barriers internationally. Following this declaration, state media has echoed the government's message, warning against involution, a term that describes a situation where competition becomes so intense that it leads to self-destructive outcomes. Tai Hui, the Asia-Pacific chief market strategist at JPMorgan Asset Management, noted that this announcement has alleviated major concerns among investors, particularly regarding the shrinking profit margins in several promising sectors. Both traditional industries, such as steel and coal, and emerging sectors like solar energy and electric vehicles are currently grappling with the challenges of overcapacity and declining prices. Despite numerous warnings in the past, decisive action has often been lacking. However, recent responses from various ministries, regulatory bodies, and local governments suggest that Beijing's message is resonating. Just 2 days after the high-level policy meeting on July 1st, the Ministry of Industry committed to curbing price wars within the solar sector, which has resulted in an 11% increase in China's photovoltaic industry index this month. Furthermore, polysilicon prices have skyrocketed by 68% following reports that the two largest producers in the sector are planning to acquire smaller competitors to consolidate their market position. In another development, a lithium mining operation in northwest China was temporarily halted due to non-compliance with regulations, prompting speculation that more such closures could occur. This week, coking coal prices, essential for steel production, reached their daily limit for 3 consecutive days after the National Energy Administration mandated inspections at mines to address excessive production. It is important to note that while Beijing has previously attempted supply-side reforms, most notably around a decade ago, to reduce output in the cement, steel, glass, and coal industries, this current endeavor may prove to be more challenging. The landscape has changed significantly, with increased private ownership in many sectors, misaligned incentives between local and national authorities, and limited alternative employment opportunities for those affected by potential job losses. The extent to which the government is willing to go in reducing production remains uncertain, as does the identification of other sectors that may be targeted for similar measures. While China's leadership is sending the strong and optimistic message about their commitment to addressing overcapacity, experts like Laura Wang, chief China equity strategist for Morgan Stanley in Hong Kong, caution that progress may be slow. Wang suggests that it could take 1 to 2 years before we see any significant improvement in corporate profits, and she expresses a conservative outlook for the next 3 to 6 months regarding actual capacity reductions. This situation raises important questions. How effective will these measures be in the long run? Will the government be able to balance the need for reform with the economic realities of job losses and private sector pushback? As we navigate these complex issues, we invite you to share your thoughts. Do you believe that Beijing's actions will lead to meaningful change, or do you think this is just another round of empty promises? Let's discuss. Chinese investors rally. Government promises to end price wars and overcapacity. Imagine a world where companies are so desperate to survive, they slash prices into the ground, triggering a race to the bottom that hurts everyone involved. Now picture a nation trying to reverse that chaos and investors betting it can. That's the story unfolding in China's markets, where a government crackdown on cutthroat competition has sparked a stock rally. But here's where it gets controversial. Will this be a lasting solution or just a temporary fix that leaves industries more fragile than ever? And what happens when global rivals push back harder than ever before? The buzzword du jour is anti-involution, a term that's become shorthand for China struggling to curb overcapacity and self-destructive price wars. Think solar panels, steel, and electric vehicles. Industries where too many players are fighting for a shrinking pie. The result? Profits evaporating, quality slipping, and trade tensions boiling over. For example, U.S. President Donald Trump's tariffs on Chinese goods have escalated the stakes, while weak domestic demand has forced manufacturers to slash prices just to stay afloat. The fallout? China's producer price index has plummeted for nearly 3 years, fueling a deflationary spiral that's spilled into global markets. Cheap Chinese exports are now a lightning rod for trade friction with the US, EU, and even emerging economies like Mexico and Indonesia. But the government is finally drawing a line in the sand. In June, solar panel glass producers agreed to cut output by 30%, and auto safety inspections have been launched to curb cost-cutting that risks safety. These moves have sent shockwaves through the stock market. Laizhou Iron and Steel Co. surged 10% in one day, while solar glass maker Changzhou Aluminium Co. gained 50% despite a recent dip. Broader ETFs in solar and steel have outperformed the Shanghai Composite by a wide margin, yet EV stocks remain mixed. Li Auto and NIO are up double digits, but market leader BYD is down. What's driving this split? Some analysts argue the EV sector's price wars are deeper rooted, with overcapacity still a looming threat. And this is the part most people miss. The problem isn't just economics, it's politics. Local governments, eager to protect jobs and tax revenue, often fuel overinvestment by subsidizing factories. That's why even as the central government pushes for consolidation, provincial leaders might resist. Alicia Garcia Herrero, an economist at Natixis, calls this a big problem for China, but admits it's unclear how much action will follow the rhetoric. Meanwhile, the Communist Party's Qiushi magazine warns that overcapacity forces companies to live in control and compete for survival in a limited market, a dynamic that's stifled innovation and quality. So, is this the start of a new era for China's industries, or just a short-lived ceasefire? The stakes are huge. If the government succeeds, it could stabilize markets and ease global tensions. But if it fails, the fallout could be catastrophic. More bankruptcies, deeper trade wars, and a crisis of confidence in China's economic model. Here's a question for you. Do you think China's top-down approach can truly fix industries where local governments have their own agendas? Or is this just another case of promises outpacing action? Drop your thoughts in the comments. Let's debate what comes next.